Hi there. Thanks for tuning in. Today we're going to be doing an updated stock analysis of Nomad Foods. Last time I did an analysis on the stock, it was around late 2023, if I'm remembering correctly. So let's do an update. A lot has happened since. We'll do an updated valuation and we'll look at whether or not this is an interesting investment prospect based on my estimates. This is not really investment advice, this is for fun. But if you like what I do, you can do your own model. You can use it as a starting point for your analysis and go from there. If you like these kinds of videos, don't forget to like and subscribe. And also, this is a viewer request. If you want me to look at any particular companies, comment down below and I'll take a look. So let's get started. First of all, Nomad Foods, they sell frozen products in Europe. Goodfellas is one of their big brands. They have a couple other ones. Iglo, for example. They sell in the UK, in France, in Croatia, in Germany, in Italy. They have all sorts of different brands there, but most of their income comes from sort of UK, France, Germany, Croatia, and then the rest of Europe. And here's the distribution actually. So you'll see that UK is their biggest customer, followed by Italy, Germany, France, Croatia, and then the numbers start getting smaller from there onwards. But they're all over Europe. They're growing. They generally acquire other brands, and that's how they grow into new markets because those brands are popular there. Those brands already did some legwork. They acquire them, they bring them into the Nomad Foods family, and go from there. And oftentimes, those acquisitions are done with debt. So it's important to note because they will carry a certain amount of debt as a company, and we'll look into that later. Talking about the second quarter of 2025, which is the latest earnings release, they're talking about contracting organic growth as the savored frozen food category weakened further than expected due to unfavorable weather. There was a very hot European summer. That's not good for them. So the value and volume share stabilized. Okay, so they're saying we didn't do that great, but we expect it to stabilize. They expect to get better next year. And they still did their return cash to shareholders in the form of share repurchases, 100 million euros, and dividend payments. So generally, they still are giving you something back for holding the stock between those repurchases and that dividend. However, their full year expectations, which are lowered, they do come with an expectation to return to organic sales growth in the third quarter as long as the weather gets a little colder. They also have positive free cash flow. We love to see that. We love that they're highlighting it. And while revenues are down and profits are down, free cash flow is up, generally because of lower capex, because of lower changes in working capital and other stuff. So it's not like it's a huge buck of the trend, but you like to see that they're keeping sort of the strength in that free cash flow that they can generate. That percentage of adjusted profit for the period is actually going up. You like to see that. Their guidance has changed, so organic revenue is going to be between flat and -2%. Their adjusted EBITDA down even lower. Their earnings per share lower as well. I don't really care about this number because that can be manipulated by issuing or repurchasing shares, but that's still important to note. And in the model that I'm going to show you in a little bit, that has to be accounted for. If we look at the long term picture, another interesting thing is that they have not grown revenues for the first time in a while. They were a very consistent grower. 2021, complicated year, but other than that, they had pretty great growth in the mid single digits or even double digits sometimes. Now, their margins are generally pretty steady, hovering around that 30% level, down a little, but that's no big deal. Their operating margins also hovering around that 15% level, and their return on invested capital hovering around that 4 to 5%. So margins stay decent. If they start contracting as revenue contracts, I would say that is a worrying sign. And even though the long term trend is down a little bit, it's not that concerning because it's still within, let's call it a standard deviation or a normal range. Now, I want to do a discounted cash flow model here. So, what I'm doing, first of all, note that their numbers are in euros. I'm going to use US dollars because we're looking at their listing in the New York Stock Exchange. So, I'm changing the cash flow for the year to dollars, and I'm saying it's going to be down for 2025 compared to what it was in 2024, then 2026, 27, and 28, roughly 11% of the estimated revenues are going to be turned to free cash flow. And then from there onwards, they're going to have a very mild revenue growth, most likely of around 2%. And from then on, I'm going to grow it perpetually by 2% per year. My required rate of return for all the stocks I analyze is 11%. So if we grab the value and then plug these two percentages in, divide it by the total number of shares out, I think that each share of Nomad Foods should be worth $28.12 per share. However, because they have a lot of net debt, we have to subtract that. So subtracting the net debt from the total value and dividing it once again by the total number of shares out gives you $13.73 per share with the net debt included. Once again, with an 11% per year required rate of return. That's just my personal required rate of return, and a 2% perpetual growth rate. That's how much I think they can grow forever. Now, if we compare it to the stock price, it's basically a little more than 10% down from that. So, and the long-term trend is not great. It's not looking fantastic here. If you bought it 5 years ago, you've lost half your money. You're not happy with that. Right now it's looking interesting because the PE is in the single digits. It's below 8. The dividend yield is looking pretty high. What's the problem with this low PE is that once earnings drop, this PE will go back up. So this PE is backwards looking. What happens forwards once earnings drop? The PE actually goes up. So it's not a great point of reference here. The dividend yield is something that you have to just compare it to the cash flows, how much they are issuing out of the free cash flow, and if that's a realistic thing to keep up. So far, not terrible because their cash flows are still steady. And as long as they're steady, the dividend yield and the share repurchases can give you some value back. But if you'll see, this the value here can be propped up by that, but it's not everything because all of a sudden they didn't start growing and people fled from it, as well as maybe weak European demand, which seems to be true in general. Right now, you're seeing a lot in the news cycle about a European fiscal crisis. If that gets to the consumer, then Nomad Foods will suffer too, whether we like it or not. So, in summary, I still think it's roughly fairly valued. Last time I analyzed it, it was a little higher, and I thought it was right about there. Right now, why is it lower? Very simple. One of them is I lowered my perpetual rate of return or my perpetual growth rate from 3% to 2% in line with sort of the Eurozone being a little slower growing. And also, their debt is more now. Even though they repurchase some shares, they have more debt. They have less net profits because the interest payments are higher. So, because of this, I still think it's fairly valued, and their value has actually decreased a little bit. However, you probably wouldn't do that bad holding this company. Between the dividend, the share buybacks, and some possible price appreciation coming from the fact that, according to this somewhat conservative model, it's about a little more than 10% undervalued. And the consistent margins are great to see. If they can keep it up, then even in bad years, they can still hold on to something to capitalize for when it gets better. Are there better opportunities out there? Perhaps this is in the end of lower risk and low to medium reward, where you're taking a little bit of risk to get something like that 11% rate of return between the dividends, the buybacks, the appreciation. If you obviously require less than that, a 9%, an 8%, 7% even, this is kind of closer to that buy territory. But if you require more, there may be more interesting things out there. So, where does this fit in your portfolio? Are you looking for something that is a single or are you looking for a home run? This right now is in that single territory. But if you're the kind of investor that likes to do a concentrated position, who likes to take more risk and look for that home run, this is not it at the moment. And even though it's down 50%, we can see that there are bigger things that are justifying the fact that it's down in price so much. Now, I hope you learned a lot from this video. Thank you so much for watching, and if you liked it, don't forget to like and subscribe. Once again, thank you, and have a great rest of your day.